Most of us think of the global financial system as a single, towering monolith. But right alongside Wall Street and standard banking, there is a massive parallel architecture operating on entirely different rules. To see how this works in practice, you have to look at Malaysia. It runs a fully integrated dual system, where conventional finance and Islamic finance trade side by side every single day. Malaysia's capital market sits at 2.9 trillion ringgit. The Islamic market accounts for 1.8 trillion of that total. Looking closely reveals a distinct mechanical foundation. The Islamic portion relies on financial components absent from the conventional side. The conventional side is engineered to maximize profit, mostly through debt and interest. The Islamic side strictly forbids interest, gambling, and uncertainty, requiring every transaction to be backed by a real physical asset. Choosing which system to allocate your capital to dictates your exposure to market crashes, changes your legal protections, and determines access to your cash. This diagram maps out two approaches to financial risk. Conventional markets operate on risk transfer. Lending guarantees fixed returns, shifting the burden of failure onto borrowers. Islamic markets mandate risk sharing. Your money is tied to tangible activity, splitting profits and sharing losses proportionally. Shifting all that risk to the borrower gives the lender highly predictable returns. But when an entire economy operates this way, the accumulated debt fuels speculative bubbles. Tying capital to physical assets keeps the macroeconomy grounded and stable. The trade-off is that the investor loses the comfort of guaranteed, insulated payouts. Financial risk never actually disappears. The choice between these systems comes down to whether you want to isolate that risk on borrowers, which creates systemic fragility, or distribute it across the market to maintain stability. These opposing philosophies dictate the actual products you can buy. Take a conventional bond. It is a straightforward debt obligation. You receive an IOU promising a fixed interest payment. The Islamic equivalent is a sukuk. Instead of debt, it represents proportional ownership. You buy a fractional piece of a tangible physical project. Because bonds are simple debt contracts, they are incredibly liquid. They operate on highly standardized global rules, making them extremely fast and easy to trade. Sukuk lack that frictionless trading speed, but their asset-backed nature gives them a different edge. Because they are tied to real-world performance rather than interest rates, they remain highly insulated against central bank policy changes and global financial panics. But there is a catch for sukuk investors. Since your returns rely on the project actually succeeding, you have to do the work to understand the underlying asset. If the project fails, it isn't a standard debt default, it's an equity loss. So as an allocator, buying a bond means you are betting on an entity's legal obligation to pay its debt. Buying a sukuk means you are betting on the actual commercial success of a physical project. To ensure these distinct systems don't collapse, they require entirely different styles of policing. In Malaysia, the ultimate referee is Bank Negara Malaysia. Conventional markets operate on free market mechanics. Regulators primarily use interest rate levers to speed up or slow down the economy, letting profit motives drive the rest. This hands-off flexibility allows institutions to invent and deploy new financial products rapidly. However, it leaves the system exposed to rampant speculation and the kind of systemic crises we saw in 2008. The Islamic system utilizes a much stricter, multi-tiered governance structure. Regulations like Malaysia's Islamic Financial Services Act explicitly ban the mechanics of interest, prohibit excessive market uncertainty, and eliminate financial speculation. Failing to maintain Sharia compliance carries specific legal consequences under the IFSA 2013. Convicted parties can face fines up to 25 million ringgit and prison sentences of up to 8 years, ensuring unmatched institutional trust. Conventional regulators optimize for frictionless speed and market innovation. Islamic regulators optimize for ethical integrity and absolute stakeholder protection. Building a highly regulated, ethically sound financial fortress sounds great on paper, but it introduces severe operational friction. The first major hurdle is liquidity. Without standard interest-bearing tools like conventional repos, managing short-term cash flow is a chronic, expensive challenge for Islamic institutions. This map illustrates another headache: Sharia harmonization. Different countries have their own advisory boards. A product approved in one region is frequently rejected elsewhere. Additionally, international disputes over Islamic contracts are often forced into secular civil courts, where judges lack Sharia nuance. This legal friction is compounded by a severe talent shortage. The market desperately needs professionals trained in both modern data analytics and classical Islamic jurisprudence, and there just aren't enough of them. Finally, there is a serious digital barrier. Due to institutional hesitation and poor tech infrastructure in emerging markets, the Islamic ecosystem is lagging years behind conventional finance in fintech and AI adoption. The price of Islamic financial stability is a fragmented, higher-cost operating environment that struggles to scale with the ruthless efficiency of standard global markets. So looking at these two entirely different approaches, how do you actually allocate your capital today? This flowchart breaks down your options. You have to choose between a high-liquidity debt engine and a highly regulated risk-sharing fortress. If you want a pragmatic hedge against global interest rate volatility, allocating a portion to Sukuk makes sense. You secure asset-backed stability, as long as you can tolerate lower secondary liquidity. If your priority is max liquidity, standardized global laws, and fast trading tech, you should stick to the conventional side. But you have to accept your exposure to systemic debt crashes. If your goal is to tie your money to real economy impact and strict ethical rules, commit to the Islamic capital market. Just be prepared to navigate global legal fragmentation and slower tech adoption. Neither market is objectively perfect. Your decision entirely depends on whether you value the frictionless speed of debt or the grounded resilience of shared equity.